Today we are starting with the first topic on the valuation course, and this is what we call value creation. Well, the first question we ask here is, what do you mean by value creation? You know why we are actually doing this valuation course? What value will this add in the entire scheme of things when we look at a company? There is a company A, and you put in $100 in that. After 10 years, what is the value this $100 has created? It could be that the share now is for $90. Or it could be this share is worth $10,000, which will make you very rich. What is happening here? This $100 is converted into $90 over a period of 10 years, and we have lost $10. So in a way, what we are trying to say is this is value destroyed. The company owners were not able to create a value for this share for its shareholders. And what they have done is, instead of creating, they have literally destroyed it. Your money, which you invested like $100, is now $90. And in this case, our scenario B, this $100 is converted into $10,000, which is literally 100 times of what you made the investment in company A. So this company has created value to the tune of 100x. So let's see it with the perspective of why value creation, or why valuing a company, is important. Just to understand whether a potential of a company to create value exists, or it's basically a value destroyer. So let's give the perspective what has happened in the past and why valuing a company is an important topic. So here's a chart. We're looking at NASDAQ performance over the 15-odd years, and we see a basic trend, which is this, at peak, or you can even see here at low. So this is your IT bubble, which is happening. The market caps are going up, and drastically they crashed to their previous levels, and in this market is going up, and practically it comes down once the Lehman Brothers thing happened in 2008. So surprisingly, when we talk of the IT bubble in 2000, 2001, so what really happened in 95 to 2000 was there were a lot of companies after Netscape, which got listed, and their values got really up. A lot of IT companies were created. Small-time companies became big companies. Everyone was talking about IT is the next thing, and that is creating value for any business and market. It was literally driven by IT companies. And what really happened was there was laws of economics that prevailed. We were in 2001 when we saw a drastic crash in the values of these IT companies, which brought the overall NASDAQ or any index performance back to its normal or previous levels, primarily indicating that there were laws. Economics prevail, and the any company's value is not driven by notions. It's primarily what really drives that. What are the returns which companies generating? What is the revenue growth which a company is generating? And these IT companies were not able to generate that level of returns, and those companies who performed well, even in this bubble, were those companies who had a very good return, who were able to grow their revenues year on year, who had their cost of capital in a decent level such that their return were more than their cost and their growth was positive. That created value. But most of the other companies, instead of following the bubble or the notions of investors, they fell back because fundamentals prevailed. Well, if we look at 2008 financial crisis, we see that there were fundamental assumptions which were made by a lot of banks, including Lehman Brothers, that if you securitize your home loans, that will value your home loans better, it will make the home loans more valuable. And the second was, if you use a lot of leverage to make this investment, it will create value. So both these assumptions were flawed, because at the end, what really creates value is that particular asset. And if that asset is not performing it, the value cannot be created whether you're using your own funds or you are taking loan from a bank in the form of leverage. That has nothing to do with value creation. If you're investing $100 from your pocket, or if you're investing that $100 by taking loan, how that $100 performs depends on that asset class in which that investment is being made. And sure, in your workings you will consider the leverage part and the interest paid, but the value creation of that $100 in a previous question, $100 went up to $10,000. You just made $100 investment that was through equity, your own money, or through a bank loan. That's a secondary question. But that $100 were converted into $10,000. That's the value creation which we are talking about, and that has nothing to do with through what means the investment is made. That basically depends on people who are managing that money, how much value they are creating, and that again is through three drivers. Let me just write it down. It's return, cost, and growth. So whenever you talk of valuation, these are the three drivers, and you need to really consider, from a quantitative perspective what is happening to these three. In the past, what is happening to these three in the future, what will happen to these three elements for any company you're valuing, and you will get your answer. And well, more often than not, what we hear is when will the next financial crisis happen? Well, the answer to this question is anytime. So what companies should do is really to equip themselves, have good risk management teams within them, and if they have everything in order, they will be able to reduce the impact of next financial crisis because these kind of events are not one-off. If you look at the past history, especially when we talk of US market, the past 100 years history that these kind of financial crises come on and off, and there are a lot of reasons for them. Come in at one point in time, they might be investors' notion the other point in time, there might be bank assumption flaws, and this thing will continue forever. So we as investors, or a companies, what they need to do is we need to assess that risk element, that understanding whether companies prepared for the next financial crisis or not. And we should consider this aspect as well when we are valuing any company.